Matt, what were the first couple of things that you ordered from Amazon and what year?
I was a little late to the game. So January 2010 is my first order. So we were just coming out of college then. And I feel like I ordered the perfect thing for 2010. I ordered P90X. We look at the books, and the first book I ordered from Amazon was Physics for Future Presidents, The Science Behind the Headlines. And the second book I ordered was .con, which is a book that we're reading now for this series. And then when you scroll later in the year, after I had started my first job as a currency trader at Morgan Stanley, is the first time I bought and read Gold, Dollars, and Power, that book we were talking about during the Nixon shock.
Nice. My history starts in 2006. I ordered a map of some sort that's not available anymore, so I can't even see exactly what it is. And I definitely don't remember it. Nothing in 2007. And then in 2008, that's when activity picked up big time. And I had 3 economics books, 4 philosophy books, 1 fluid mechanics books, which I'm pretty sure was for an engineering class, and 4 gifts, 2 CDs, and 2 books for, I think, one of my sisters. So that's my history. A little less exciting. You ready to go?
Let's do it.
The style of competition in the increasing returns arena is more like gambling, not poker, where the game is static and the players vie for succession of pots. It is casino gambling, where part of the game is to choose which games to play, as well as playing them with skill. We can imagine the top figures in high tech, the Gateses and Gertzners and Groves of their industries, as milling in a large casino. Over at this table, a game is starting called multimedia. Over at that one, a game called web services. In the corner is electronic banking. There are many such tables. You sit at one. How much to play, you ask. 3 billion, the Kruper replies. Who'll be playing? We won't know until they show up. What are the rules? Those will emerge as the game unfolds. What are my odds of winning? We can't say. Do you still want to play? High-tech pursuit at this level is not for the timid. In fact, the art of playing the tables in the casino of technology is primarily a psychological one. What counts to some degree, but only to some degree, is technical expertise, deep pockets, will, and courage. Above all, the rewards go to the players who are first to make sense of the new games looming out of the technological fog, to see their shape, to recognize them. Bill Gates is not so much a wizard of technology as a wizard of precognition, of discerning the shape of the next game. Matt, this is an excerpt from an article published in 1996 titled Increasing Returns and the New World of Business by William Brian Arthur, who is an economist focused on complexity, technology, and financial markets. And it's one of my favorite, most counterintuitive mental models. And kind of shockingly, it was written well before the dot-com boom really got going, about a year after Netscape's IPO in 1996. It's fantastic. And I didn't realize this when we started this series, but Bill Gates has pretty much come up in every single episode.
Yep. He's the bad guy. Bad guy throughout.
He's the
Is
guy.
he still the bad guy?
All right, Matt, this is not the Amazon story. I think we should say that up front. I think that story has been told 1,000 times. And while, it's an amazing story, no doubt, the premise of what we're doing here at Backtest, which is all about markets, our context, individual company playbooks are super interesting, but to really master them, to really understand the plays and how to apply them, you have to understand the markets, right? The circumstances in which those plays worked. And the context for any startup is, especially one riding a massive technological wave, is always the market, right? What is the market doing, both in the sense of the financial markets and in the sense of kind of what technologies are out there and what the competitive landscape looks like. And I should also note that we set out, in our research for this episode, thinking this would be a story about hype, right? Like, what does a market bubble look like as it inflates? What does that market mania feel like to the people that are experiencing it? But that is actually not the story that we found, right? Like, the story that we found is much more interesting than like pets.com or Webvan or any of these companies that didn't stand the test of time. This is really a story about seeing a revolutionary technology early, right? Seeing it early enough to position yourself in a great place to ride it as it opens up new markets and there's new games to be played, and then attacking that wave aggressively, intelligently, to build a lasting business as you're surfing the wave without wiping out, and before the wave of capital and expectations kind of crashes on itself, as it always does. This is really the story of what Jeff Bezos saw in 1994 that convinced him, that gave him conviction that the web was the opportunity of a lifetime, right? It's a story about why he focused on books, why it was important to get big fast. It's a story about how Amazon navigated the mania and then ultimately how they survived the crash, which was definitely not a foregone conclusion. And there's a few things they did that I think were very smart that I think we can learn from in the context of the market that they were navigating. So this is really the story of jumping onto and navigating massive technological revolutions without wiping out.
Yep.
So before we dive into what Jeff saw in 1994, which is one of the core questions we want to answer, I think we need a little bit of context on who Jeff is and where he was coming from, at that point in time. And there's actually another question too, is what was happening in the economy in 1994 and sort of throughout Jeff's career post-college. So those two questions, I think we need to set a little bit the stage before we dive into what he saw in 1994. There's also, by the way, a lot of other resources out there for anybody who wants to dive deeper, and we'll have this in the show notes. But, Brad Stone's book, The Everything Store, is a fantastic resource. There's a ton of articles about this time period. The Acquired team, David and Ben, did an awesome job with their Amazon episodes. They even have an episode where they interview Tom Alberg, who was one of the original board members at Amazon. So there's just a lot of content about the history of Amazon.
The shareholder letters themselves are also great resources.
Shareholder letters are fantastic. So we'll have a link to all this stuff if anybody wants to dive deeper. But Jeff was born 1964 in Albuquerque, New Mexico. His mom, famously, was only 17 years old when she had him, and his dad was 19 at the time. Kind of hard to imagine, even now, right? Like that is a very young age, and Jeff's mom was still in high school. Hard to imagine that now. Imagine that in the 60s, right? So extremely difficult, to go through this. His parents tried to make it work. So Jackie and Ted tried to make it work. They ultimately got divorced pretty quickly by the time Jeff was about 17 months old. Jackie ends up remarrying when Jeff was 4 to this guy, Miguel, who went by Mike Bezos, who adopted Jeff. And of course, Jeff takes on his last name. Mike Bezos has a really interesting background. He's originally from Cuba, emigrated to the US on a refugee visa when he was 16. Fidel Castro expropriated his family's lumber business, and so they realized we have no future, we have to leave. So he comes to the US on a refugee visa. He got a scholarship to the University of Albuquerque in New Mexico, which is where he ends up meeting Jackie, and he graduated with a degree in computer science, and he ends up taking a job at Exxon. So moves to Houston. I think immediately you can paint a picture that Jeff is growing up in a family that really values self-reliance and resilience and unconventional paths in life. On top of that, Jeff's maternal grandfather, Lawrence Preston Guise, he was the regional director of the U.S. Atomic Energy Commission in Albuquerque. By the time Jeff is a little kid, he had retired to his family's ranch in Cotulla, Texas, which is where Jeff ends up spending most of his summers as he's growing up there with him, basically fixing machinery, building fences, vaccinating cattle. And there's a ton of stories that Jeff likes to tell that sort of paint a picture. But really, Jeff is growing up. He's a really smart, curious kid. He's got a lot of access to opportunities to learn about the world and people around him that reinforce this idea of self-reliance and resilience. And that really, in a nutshell, sums up the character of Jeff Bezos. He ends up graduating from high school in Miami as a valedictorian and National Merit Scholar. He went to Princeton, graduated with a degree in electrical engineering and computer science in 1986. And he had job offers from great companies like Intel, which was a darling tech company at the time, Bell Labs, which is at the epicenter in the 80s of all these new technologies that are coming out, especially around electronics, some consulting companies. But ultimately, he actually chose a very small startup with like 10, 11 people called Fitel, which was a fintech, effectively building a system for clearing and settling transactions. So not a trading shop, not an investment shop, basically a technology infrastructure startup. And so he was there early on the team. It's worth pausing too. If you look at interviews with Jeff that describe this time period, why Fitel, right? Like, why not go to one of these other bigger companies? And the way that he puts it, he knew that he wanted to be an entrepreneur, right? Like he knew he wanted to start a company, and he didn't have any good ideas coming out of college. And so he decided, hey, I'm going to go join a small startup to learn. And that's actually a theme of his pre-Amazon career. It's that he's basically a learning machine, and he's trying to absorb as much as possible while keeping an eye out for opportunities and ideas to start his own company. After 2 years at Patel, he says that it kind of wasn't going anywhere special, but he had great experience there. But after 2 years, he moves on to Bankers Trust, which is a bigger entity, a more stable company. He works on portfolio analysis tools. And I think he's really starting to sharpen his skills as kind of a technical person that can build things, but also, a product leader and a very commercially minded person. And so the intersection of those two things is really what makes him special. The backdrop of this time period is also really significant, right? So there are two critical things that kind of set the tone in the market and the economy at this time. One, remember that Paul Volcker was appointed Fed chairman in 1979 to tackle inflation. And we talked a little bit about some of this stuff during the Nixon shock series. But by 1986, rates had gotten as high as 20% because inflation had reached like 13.5% at one point. But by 1986, Volcker had tamed inflation. He had gotten it under control. Oil was cheap. Reagan had come in and started to cut taxes and deregulate the economy. And everything was picking up momentum, right? And you remember we talked, in part 2 also about the fact that the telecom industry had deregulated in 1984. And so AT&T had been broken apart. And so all of this, is leading to a much more dynamic U.S. economy in the 80s. The Soviet Union collapsed in 1989, leaving the U.S. as the kind of sole superpower in the world. And then on top of these macro trends on Wall Street, things are booming, right? You have the high yield bonds financing leverage buyouts. Greenspan came into the Fed in 1987. He masterfully navigated the stock crash of 1987 without causing major instability in the economy. It's a pretty positive time period up until about 1990 or so, where the boom dissipates. There's a collapse in the high yield market. Michael Milken, the founder of the high yield bond market, gets prosecuted. There's a mild recession from 90 to 91.
Yeah, I would add 2 or 3 things to kind of the market and economy backdrop. The first is that in 1994, we're actually already 3 years into a stock market expansion, and the average expansion is 3 years, right? And so we're already at the average length of a stock market expansion in 1994. This is going to go on to be just the beginning of what is the longest stock market expansion on record. But I think that's pretty important that we're 3 years into like a good time period. Right at this time in 94, the Fed is just starting to raise rates from about 3% to about 6% after that recession you mentioned. They lowered them a bunch to 3%. Now they're coming back up. So signaling, the economy is looking pretty good. Last thing just to note here right in the beginning is that technology is 9% of the S&P 500 and telecom is 7%. So we're at about 15 or 16% of the total index here as we kind of kick things off in 1994.
And I think just to put ourselves in maybe Jeff's shoes, right, as he's coming out of college in 86, navigating inside of the financial world as a technology infrastructure person, the late 80s into the early 90s, I think we've all been in seats where, the market backdrop definitely affects psychology and affects the kind of opportunities that you might go chase. And so we left him off about 1990 at Bankers Trust. And so now you're in the middle of a recession. He looks around and says, you know what, I don't want to do this finance thing anymore. I don't want to be in the finance world. I want to go to tech. Like that's really what I've wanted to do all along. And so he starts putting out feelers. And what's really interesting is that he gets a call from a headhunter who basically says, hey, I know you want to go to tech. I know you don't want to talk about finance, but I've got something that could be really interesting for you. And that is how he meets David Shaw. And David Shaw goes on to be extremely important for Jeff Bezos' career for reasons that we're about to dive into, but a little bit of background on him. Up until 1986, he had been a professor of computer science at Columbia, right? He got his PhD at Stanford. In 86, he decides to leave Columbia and go be a VP at Morgan Stanley, basically in their prop trading group. This is sort of the advent of technology starting to revolutionize finance. And so he joins Morgan Stanley. After 2 years, he decides he wants to go out on his own. And for a little bit of context, in 1982 is when Renaissance Technologies starts, which is the first quant trading fund, which was basically all mathematicians and physicists coming together to try to figure out the market and trade it in ways that are very different to what somebody might consider a traditional portfolio manager or an investor. And so I think David Shaw is seeing some of this stuff and seeing all these academics that went on to Renaissance and founded and created an amazing kind of investment technology group. And he wants to do something similar. And so he starts D.E. Shaw in 1988.
David Shaw. So he spent this academic part of his career essentially studying computer science as how it applied to math equations. And what he saw there was that distributed networks, right, or computers distributed on a network, transformed computation, right? They transformed how you do math. And so now he's out. Now we're at the part of the story where he's out in the world. He's discovered that distributed networks can transform investing and trading. But he kind of has this mental model of like this distributed network thing changes the game in these different areas.
Yeah, for sure. Well, and on top of that, right, like he was at Columbia and at Stanford during a time period when ARPANET was big in academic circles. And so he has exposure to ARPANET and to communicating with other academics and researchers, like we talked about in the Netscape episode, inside of the academic circles through this distributed network. And that's going to play a massive role in what's coming. One thing I want to mention too, which is critical, is that the way that Jeff describes David, lest you think that he's just some kind of nerdy academic that just like focuses on numbers all day. He says he was one of those people who has a completely developed left brain and a completely developed right brain. He's artistic, articulate, and analytical. It's just a pleasure to talk to someone like that. So, Jeff comes into this thinking he's leaving finance, and he meets David Shaw, and he sort of falls in love with this company. He really comes to like David, and he decides to take a job there in 1990.
I think it's important to punch on the fact that D. Shaw is a startup at this point, right? Like D. Shaw is 2 years old. In 1988, they raised $25 million and had 6 people. And so you have Bezos coming over here. So this was a risky move as well.
It was risky, but in a way, it was also very much in line with everything Jeff had done to this point, right? Like he's joining these small teams to learn and to train, but also to take a shot at positioning himself in these smaller companies for the potential that they might scale and they might become bigger deals. Like he wants to build a business. He wants to be an entrepreneur and own a business. But at this point, he's really focused on, hey, I don't have a great idea just yet. I'm going to join businesses that I think have a lot of potential and I can help, make an impact. And so what he ends up doing, he joins this small team, which, by the way, it's mostly scientists and academics and researchers. And, this is not a traditional Wall Street kind of banker or finance types. These are scientists, engineers, mathematicians. And Jeff's job is to basically build software for quant trading and market making. That's his job at first. He's building pricing and arbitrage tools. He's building order routing logic, internal database, that sort of thing. And it's all this amalgamation of computer science, finance, and systems engineering, which, of course, comes to play a big role in Jeff's life later. But he develops a reputation for being really good at this intersection of technical and commercial, right? Like shipping fast, product-minded, technical person, which is super valuable because it allowed him to see the whole field. And maybe more importantly, it allows him to build a lot of credibility and trust with David himself. And so now we're fully primed with the setup for one of the questions that we both wanted to understand. What exactly did Jeff see in 1994 that gave him the conviction to start Amazon? And in my mind, it all starts with David Shaw. Because we talked in part 2 about John Malone being in this perfect seat, right? The seat that allowed him to see and collect all these puzzle pieces and understand markets before anyone else. Jeff is going to do that here, but he's a huge beneficiary of the puzzle pieces that David brought to the table. Again, he used ARPANET. He had used NSFNet, which is the actual precursor to the internet. But it's also important to note that at this point, so pre-1993, NSFNet cannot be used for commercial purposes, right? Like it's basically this giant network for communications, mostly for researchers and academics, but you can't use it for any sort of commercial selling or transactions or anything like that. But there are discussions already in the government, led by Al Gore, among others. They want to turn this into a commercial distributed network for all sorts of things and just open up the floodgates to the private sector. In addition to that, did you know that D. Shaw was actually not using traditional trading computers? They were using Sun workstations, and they had access to the internet at D. Shaw. Because a lot of these people are coming from the academic world, right? And so they had access to things like email and Mosaic, and they had access to Gopher and all these other tools that are built on top of NSFNet. So anyway, fast forward to 1993, National Information Infrastructure Act gets passed. A couple of months after Mosaic was released, David and Jeff are both tuned into the potential to create this massive low friction information network. And David in particular understood, like you said, the potential for these distributed systems to be very important and kind of permeate through the economy. And so in late 1993, early 94, David reassigns Jeff to lead a project to explore internet business opportunities. And it's basically a way to map out all these potential businesses that they might be able to start or invest in because the internet is now going to be this commercial network. And so Jeff sits down, he creates this scoring model for product categories like things like catalog size and standardization of products and shipping and logistics and supplier fragmentation, all the things that you might do if you're trying to map a market. And then David and Jeff would basically meet every week for a few hours. They would brainstorm, and they started to rank these based on which ones might benefit the most from the web. And so they come up with books, music, software, electronics, video, stuff like that. One idea, for example, was they came up with the idea for a free ad-supported email service for consumers. And that ended up becoming this company, Juno, that went public in 1999 and then merged with another company called NetZero. Another idea was an online stock trading service. You can basically picture E-Trade, right? But it wasn't E-Trade. It was something else that Diashoff started, grew a bit, and then sold to Merrill Lynch. All of this brainstorming, mapping potential markets, it really fueled Jeff's curiosity. And he starts digging into the technical aspects of the web. Before he settles in on the concept of the everything store, he starts digging into the technical pieces of what's going on. And there's one stat that he always talks about that jumped out at him. He opened up this newsletter called Matrix News, and he sees that the internet is growing at 2,300%. The web in particular, right? Because if you actually look, and we'll link this to the show notes because we have the two charts that he saw. There's a chart about bytes and there's a chart about internet packets, so data going across different networks, FTP and others. But the World Wide Web was growing at a massive rate. And that 2,300% that Jeff always quotes in interviews and talks that he gives is actually wrong, because if you do the math, when you look at those charts, it's not 2,300%, it's 2,300x. So he was low by 100x. But nonetheless, even if you were 2,300%, that's an incredible amount of growth.
Right. And I think it's super important you talked about how the traffic was on the web, right? So the web was one of the many protocols that data was traveling on. There were all these other protocols, but most of these protocols were for research only or academics only or universities only. And then the protocol that was for consumers that you called the web was for regular people. Right. The web was for just the average person that wanted to web surf. It wasn't for researchers or academics. And so when you see that the regular person protocol is growing at 2,300x, another word for regular person is consumer, right? And so the huge takeaway is that it's actually the consumer internet specifically that is growing at 2,300x. And to me, the big insight here is, ordinary people are now using personal computers and browsers to explore and communicate on the internet for the first time ever at this massively explosive growth rate. And so I think that the consumer internet part of this ends up being a major sort of second filter along with just the raw growth.
Yeah, that's exactly right. And what's fascinating too is that it was really hard to get on the web at this time. It wasn't easy, right? It wasn't like you had an ISP that you could just like insert a CD or a floppy disk in your computer the way that you can a couple of years later with an AOL service or something like that. At this time, you had to go through a bunch of different steps. You had to reconfigure your operating system, which was really difficult because if you made one wrong step in that process, you could nuke your whole computer. Like your computer was literally dead. You had to go buy another one. And then you had to contact one of these really small ISPs that were around at the time who were leasing trunk lines on telephone lines to then connect to a web that was extremely slow and very small. But the fact that it's growing at 2,300x signals that the early adopter curve of these early users on the internet are really getting out there and, building stuff and just navigating and trying to figure out what they're going to do with this. And so Jeff can already tell in 1994 that this kind of growth, while it'll almost certainly, slow down once you reach a more mainstream market, the fact that you would slow down for 2,300x growth doesn't really matter because, any multiple of a slowdown from that is still massive amounts of growth. And so by now you have 2 of 3 conviction puzzle pieces in place in my mind, right? If you're Jeff, you have David Shaw, who is convinced the web will be huge and has shared his sort of well thought out, well informed thesis with Jeff. And then number two, you have the usage growth, which is enormous. And Jeff understands all of this because, he's technical. He's a computer scientist. He's worked at startups and he understands growth. He understands markets and products and customer development. And he's actively on the lookout for his shot at starting his own business, right? So two puzzle pieces are in place. The third one comes out of his market research, right? So the categories and the market mapping that he was doing, he really digs into this concept of the everything store. And he kind of dismisses the feasibility of a true everything store, at least at first, and starts to focus on what is the product that might work best? Like, how do I simplify this idea into something that I can go execute right now? And he lands on books. And the reason he lands on books is because they're standardized commodities, right? Like the book that you buy at one store is the exact same thing that you buy at another store. It's non-perishable. There's no ambiguity for the buyer. Even though there were thousands of book publishers, there's only 2 distributors in the US. So it's easier to just approach those 2, and that's where you're going to source the books that you're going to sell. There are 3 million books in print, which could immediately offer this new online system differentiation from physical stores because you effectively have unlimited selection online. And he does a bit of market research. And at this point, there are a couple of booksellers that are already online in 1994. He orders a copy of a book by Isaac Asimov. And when he comes in, it's slightly damaged, right? It's not a great experience. And so at this point, Jeff knows, okay, great. This is a massive opportunity. And nobody has figured this out yet.
I approached it from a slightly higher point in the filter, right? So the first decision set is the signal around the growth rate. The second one is that it's on the consumer internet. And then, there's a bunch of options from there, right? Like you could have gone into hardware infrastructure, right? Cisco ends up being the biggest company in the world at some point. So that would have been interesting. You could have gone into applications like email or social media. But I think for hardware infrastructure, like Jeff was really focused on CapEx, asset light and regulatory light or regulatory clear. And then for the application layer, like email and social media, they were very focused on just unit economics, and it was unclear how those things would monetize. And then also just super focused on execution, feasibility. Can we actually do this? Which is a combination of skill set, and I read a lot that they were very focused on bandwidth limitations. Gaming could have been an interesting consumer play, but the bandwidth wasn't there yet for kind of a great experience. And so all of that had them filter down to commerce, right? And then I went more into how did he choose books, and you pretty much hit on everything. I spent a little bit of time comparing it to music and DVDs, and they didn't even have the things they didn't have the standardization, they didn't have the concentrated suppliers. And one major thing about the concentrated suppliers too is that these 2 suppliers, they just digitized all their data. There's a point in this battle where Barnes and Noble ends up just kind of, they say Amazon's not a bookstore, they're just a broker. Not crazy, right?
Yeah, not wrong.
It's a really good model once the data has been digitized. And then two things really stood out to me in this front. I didn't necessarily see as much when I kind of read the shareholder letters and the books, but 2 things stood out. One is that the unit economics of this, at least at the contribution margin level, could be known beforehand. So I think that makes it less of a risk, right? When you know what the unit economics are of buying a book from a supplier and selling it to somebody and shipping it to them and all that stuff. And then the second thing was the working capital dynamics of this particular business are fantastic. I looked through Amazon's financials, and the cash inflows from working capital were about 10% of aggregate revenue every year. Because they're taking the cash in, before they buy the book.
They basically have negative working capital, which is like the holy grail of any business. Is you want to be able to have your customers effectively finance your inventory for you.
Yeah. I think there is something really big about your first business being something somewhat simple, and I think having negative working capital dynamics is like a massive simplifier to the 100%. Business.
Yeah. Although arguably, I mean, I'd be curious if you came across anywhere where Jeff implies that he knew this going in, because in my mind, I don't think he did. I think they kind of lucked into a business that ended up having negative working capital dynamics. I actually don't think that he had any idea that's what
he never talked about it. He never talked about it.
Yeah.
Just something that stood out to me when I was looking through the cash flow statements. I was like, good Lord. This is
working.
Even in 2000, the working capital was over 10% of revenue.
Yeah. which I think is critical for like the survival story. But we're still sort of seeing the wave and getting on top of it, which is what he was doing in 1994. And I think it's just a brilliant move, combination of paying attention, having been prepared to see the wave, and then positioning yourself in a good spot to catch the wave once it arrives. And for anybody out there thinking, after hearing all of these things that Jeff saw in 1994, that this was obvious, that anybody would have just done it, it really wasn't. So much so that he self-funded in 1994. So he decides to formally leave D.E. Shaw to go start Amazon, moves to Seattle with his wife, Mackenzie, and self-funded the first part of it as they're kind of incorporating the business and getting ready to start building everything. And they go out for their first round in 1995. Most people were very skeptical. Most said no. He ended up raising $1 million in exchange for 20% of the company from 22 angels after like 60 plus meetings, most of which were no. And it took him 12 months just to raise the $1 million. And so this was not at all an intuitive slam dunk move to have made, unless you had all the puzzle pieces and you could see that if you could go execute on this, there's nothing else that you should do. You should go do this at this point in time.
I think a major part of that also, like in terms of the decision that was made to leave D. Shaw and pursue the Everything Store, starting with books, you had the market signal that specific to consumer, and then you did the work on where to start it, all very sort of quantitative, and you can put it in a box. The third thing, in my opinion, was the regret minimization framework.
Yes.
So like that's like a huge part of this as well. And when he talks about this in public, that's pretty much all he says.
Yeah. Yeah.
Where he says, I did this because I thought, when I looked back on my life when I was 80 years old, I would regret missing the internet. I wouldn't really regret leaving D. Shaw necessarily. I would regret missing this huge growth wave.
Yeah. Which I think, by the way, like that regret minimization framework has become a bit of a buzzword. I also think that in hindsight, if you kind of simplify it to the bare bones, I think it's absolutely right. It's still hard to make that choice because the comfortable thing would have been to just stay. But in a complete rational world, which, Jeff is a very rational person. In fact, when he was a kid, he would always play Spock when they did like Star Trek plays, right? So for somebody like that, it just made no sense to stay at D.E. Shaw if you had the opportunity to go do this. Let's fast forward a little bit to how they navigate the wave, which is kind of the second part that is super interesting about all of this, because they're going to ride the wave up. And then as the wave is cresting, they're going to do this in a very kind of intentional way, but also in a very aggressive and very bold way that when I was coming into this research, I thought, we're going to find out that the decisions they made were actually not great decisions in hindsight. And everything that I read aggregated to completely change my opinion. I actually think they navigated this very masterfully, despite some of the outcomes not quite working out. And so I'll just kind of fast forward a little bit. After they launch, demand is there. It's kind of pent up and waiting for this. The stat of internet growth and web growth maps directly into what they see when they launch their website. And, the first week they sold $10,000. That doubles within a month or so. And this is a critical data point because it informs Jeff's decision that, okay, now I validated that the internet is growing massively for consumers. Now I validated that there is demand for this concept of selling books online. And so now I'm going to double down and get big fast, right? Because in a sense, you have a gigantic market opportunity. It's a complete blue ocean. There's nobody there yet. It's still very early, but you as a startup, you're very vulnerable to competition. And so what you want to do is you want to scale as fast as possible so you can be in a leading position and capture market share efficiencies, but also mind share, right? Like you want to be in people's mind as the go-to resource for books online. And so they just hit the gas. And if you look at the stats, right, like they go from $16 million in sales in 1996, their first year, which in and of itself, that's pretty remarkable. And, this is in 1996 dollars. So you're reaching $16 million in sales in your first year, 180,000 customers, about half of which are repeat customers. In 1997, they grow about 10x to $148 million in sales in their second year, 1.5 million customers, and 58% of those are repeat customers. And so now you're really, like the growth is materializing. And then in 1998, of course, they keep growing, $610 million in sales and so on. The only conviction you need at this point is just to look at the results, the kind of market that you're surfing and capturing and just keep hitting the gas, right? And I think it introduces two critical plays in navigating the wave once you're riding it. One, you have to get big fast in a land rush. You're balancing on the edge of the adoption curve, right? Like you can't get too far ahead of adoption and demand, like we saw with some of the long distance telecoms, but you have to stay right on top of it. You have to capture and you have to generate and capture momentum and capture people's imaginations. Number two, you have to hire the best of the best, which Amazon does this. And this was a core idea at the Shaw that Jeff sort of picks up from David. But you have to find the best of the best and have them join your team because those are the people that are going to help you navigate, right, this massive wave. And famously, they hire a fantastic CFO in 1996, Joy Covey, who, she's going to go on to play a critical role when we talk about survival, right? Joy was a high school dropout who ended up graduating from Cal State, started as an accountant, spent some time as an investment banker, but critically, right before Amazon, she had helped another company, a company called DigiDesign, go public, which is why then Jeff brings her on as CFO because they're thinking about going public at this point, right? And they're thinking about, just like Netscape, can we use in 1997, can we use our IPO as marketing, right? We're spending all these dollars on marketing, trying to capture market share. Can we use our IPO to piggyback on, the hype on the web to also effectively do marketing, free marketing for us? And they go on to raise only about 54 million, which is a relatively small IPO, but it does end up having a big marketing effect for them.
And so I took the approach to this time period. I was really curious about the same thing you're curious about, which is how did Amazon make investment decisions during this time period? And the shareholder letters are very clear. This isn't a direct quote, but they say that several times. They say shareholder value is in the long term is a direct result of our ability to extend and solidify market leadership. And so like you said, that's what they're focused on. They're focused on market leadership. It is probably worth calling out that this is a high operating leverage model, right? So high fixed costs, low variable costs. And so I think at one point, Jeff said something along the lines, of it would be difficult to be a medium-sized e-commerce company.
Well, it's fascinating, right? Because in the context of navigating the wave, one of the things that I was a little skeptical about is knowing a little bit of the history of Amazon is they made a ton of investments, especially in the 98, 99 timeframe acquisitions, but a lot of stakes that they took in other companies. And the rationale for this was that we're not going to enter those categories, right? So famously, they made an investment in pets.com, but they also made an investment in a company called drugstore.com. They made another one in homegrocer.com, which was like a grocery e-commerce service, cosmo.com, which was like small items, which the unit economics on that probably would have never worked. But they made all these little investments, some of them up to like 55% of the company that they were buying, because they weren't going to enter those categories. And they were effectively buying options. And so when I looked at it through that lens and started analyzing how much stock they were deploying, then it's actually a very rational strategy in a land rush that you're not willing or able to dedicate internal resources to build these things organically, or maybe you don't think that it makes sense for you to do it organically, but you want to have the option. And so you're basically buying a call option on these different categories that if these businesses are able to grow fast and get to scale, then Amazon can come in and acquire the rest of it and make it a part of Amazon and integrate it. And if it doesn't work out, it's not gonna end you, right? Like you're not going to blow up because of these stakes.
It seemed to me like on the sort of buy versus build versus invest equation that they were balancing, I think they were using a pretty consistent framework to what they were originally using. It seemed like the framework that they built at D. Shaw was carried forward. So for example, a lot of the investments that they made, like drugstore.com comes to mind, right? I think Howard Schultz was an investor, but obviously high regulation. And so rather than trying to go and build that business, they invested in it. And so I think I saw pretty consistent themes across those things. And then anything that they bought was about market leadership. And then building was a lot about systems and scalability of systems. So when you bring it back to their investment strategy is all about market leadership. And he specifically says if we have market leadership, then we'll have more revenue, we'll be more profitable on that revenue, and we'll have a higher return on invested capital. And so it kind of begs the question, like, what metrics were they looking at the time? He lays out in his letters, it was three things. It was they were investing in their customers. They were investing in customer experience. They were investing in their brand, and they're investing in infrastructure and systems. And that, it was all the metrics around those three things that determine market leadership. What's noteworthy is what's not there, right? What's not net income is not there, right? It's all about market leadership. And when you look at their financial statements, obviously there are not many companies who experience this kind of growth. So maybe the sample set's not huge. But the thing that stood out to me was actually not their revenue growth, maybe because I already knew that, but that they were keeping up with revenue on the marketing and product spend. Like the percentage of revenue for those categories was keeping up with like 800 and 500% growth, which I imagine was hard to accomplish, actually. Like it might be harder to grow your marketing and product spend 800%, harder to do that than grow your revenue 800%.
Right. Yeah. At least at the level of quality that they were hoping to achieve, right? There's a lot of companies that get into trouble when you grow that fast and the level of quality kind of erodes as you keep trying to build it on the fly. Very difficult. I mean, I think the fundamental question that we're both getting to here as they're navigating this wave, or as we're evaluating how well they navigated the crest of the wave, is were these investments a good move? And I think in my mind, after doing all this research, unequivocally, yes. It's very difficult to, in the moment during one of these crests, to know exactly which ones of these are going to pay off, which ones of these partnerships or acquisitions or investments, stakes in companies are going to be the best ones. But you have to be in the game. You have to buy those options. And you ideally have to minimize the amount of cash that you're putting into these acquisitions and buying these stakes. You have to use your stock. Ideally, you have to use a stock that is, in your mind, priced really highly and that you're not overly diluting yourself. But you have to play this game because you're positioning yourself for growth. But importantly, I think companies get into trouble when all they do is play this game, but they don't emphasize the investments that you laid out, right? Like investments in the customer experience, investments in infrastructure and systems. If you don't do those things right, then you're probably going to end up breaking the company. You're going to either overhire, or you're going to hire the wrong people, or you're not going to build systems that scale, or you're going to violate the trust of your customers. And, Jeff famously has always said that your customer is loyal to you up until the point that you're adding value to them. But there's nothing that really prevents them from picking up and going to another site and buying their books or whatever else there, right? So I don't know about you, but I think this was a fantastic way to navigate the wave, which I didn't expect, as the conclusion that I would land on.
Yeah, no, I agree. I was very interesting to see all the thought processes that went in between into how they navigated the upswing and now the coming downswing.
Yeah. And of course, this is a good segue into the third piece of this, which is surviving the crash, because notably a lot of these companies that they invested in, pets.com, drugstore.com, et cetera, they're going to go under. They're not going to be able to achieve the scale in time to survive the capital crunch that's going to come when all capital dries up. So how does that happen? Basically, by 1999, market conditions are extremely frothy. The NASDAQ, starting in 1995, over 4 years, was up 225%. So kind of like 50% a year, plus or minus. What's crazy is that in 1999 alone, by the end of the year, it's going to double from that point, right? So from that point where it's already appreciated 50% every year for 4 years, it's going to double again at the peak in 1999. So it's a true mania at this point. And when you look at Amazon by 1999, the operational complexity does start to catch up with them a little bit, and the marketing burn is rising. And there's a lot of skeptics by this point. So, anybody who hasn't read the Amazon.bum article from Barron's from this time period should go read it. Amazon.toast by Forrester Research is another great one. There's a lot of skepticism of people who have a sense for market history at this point in 1999, thinking this is a bubble and this is not going to end well for a lot of these companies. And Amazon was right in the crosshairs as one of the major companies at this time period. I mean, they were, to some extent, other than maybe Netscape and a couple of others, they were the poster child for .com at this point. But Jeff and Joy do something that's brilliant here. And I think this is another key lesson that I took away for how to navigate really the late stages of the cresting of a wave, and certainly, right before a crash. They end up raising capital here a couple of times, which ends up being critical to their survival, right? So to me, the lesson from this that we're about to talk about is raise capital while you can. You have to be smart about the structure and about the price, but you have to raise capital. You have to raise a war chest while you can. And what they do is that they issue their first big bond. So remember, they IPO'd in 1997, $54 million. They issued a high yield bond in 98, $334 million. That was a 10-year bond with no coupon, so there is no cash. So they get the capital from investors. There's no cash interest payments. And all they have to do is basically repay the loan in 10 years, delivering a 10% annual return. So the equivalent of a 10% annual return at the payment time. That's a really long term. That's a great way to raise cash. Then they go and they do a small term loan for $75 million. But the big one is a convertible loan that they do in 1999 for $1.25 billion for 10 years. I'd get this 4.75%. So again, fairly low rate. The convert was like a 27% premium to the stock price at the time. So it was not a crazy structure by any means. And, in 1999, there's a lot of investors that missed out on this massive ride that have a ton of FOMO, especially in credit markets, thinking, how do I get in on this? And so anybody who was a laggard to the dot-com boom is looking at this going, all right, I got to go in. And that's actually like a well-known sign of a market top, when like even your grandma is asking you about, Robinhood stock tips or something like that. But anyway, they get this done. Brilliant move by Covey and Jeff Bezos in 1999. And then they do one more in 2000. They had exhausted demand at this point by US investors. But guess what? The Europeans still want to get in on this by 2000. And so they do another convertible in the euro market, $672 million. And by my calculations, Matt, so the market starts crashing in 2000. So right around the time when they're closing this in Europe, the NASDAQ is starting to crack, S&P is starting to crack, and the financing window is going to close for about 4 years. If they don't do this deal, both of the convertibles, right, the 99 one in the US and the 2000 in Europe, but if they don't do the European one, Amazon's probably insolvent by 2001. And my guess is that they have to file for bankruptcy because they would run out of cash. They would be like negative $200 million in cash by 2001 if they don't do this deal.
So there's some really interesting things happening related to the debt markets at this time, right? So first, so we're in this crazy mania period in 98 and then especially 99. In the back half of 98, the Fed is actually lowering interest rates quickly because of the long-term capital management, Russia currency issues. And so policy rates are actually coming down, even though the economy is fantastic. There's some concern over Y2K, all this stuff. And because I worked in the debt markets for so long, I actually knew that Amazon was a big debt issuer in this time, and I had assumed it was because they owned their warehouses. But upon further study, this go around, they did not own their warehouses; they were all leased, and so they're borrowing all this money. So they're a true internet company. They don't have any hard assets; they're asset light. The only other company that was a true internet company that borrowed even close to these levels was AOL. And it was pretty much just AOL and Amazon are the only ones that are true internet companies that borrowed a ton.
And that was at that time, right? Because eventually they do end up acquiring a lot of real estate, and they even have their own airline. They do become a much more capital intensive business over time. Of course, AWS is a capital intensive business.
Right. And then one other thing that I think is interesting is, the Euro bond stands out as just kind of some intrigue there. And I think I don't know exactly what was going on in the market at that time, but I think it is worth mentioning that the euro, was just issued in 1999.
The euro currency?
Yeah, so the euro currency wasn't even a thing in the world until 1999. And so my guess is there was a period where issuing euro bonds was cool because the euro was new and people wanted that exposure.
Yeah. And I think a lot of people in Europe were a little bit late to the game in .com. And so similar to that 99 convert that gets done in the US by some of the investor laggards, it's the same thing in Europe a year later with the euro currency, brand new, plus these laggards kind of wanting to get into a hot .com company. And boom, there you go. You can get a deal done for a little over $600 million. And what happens next is it's sort of historic because, of course, market crashes. And if you look at a chart of Amazon all the way to today, this is a blip. You can't even see it, right? Amazon is such a massive company. But if you zoom in on this time period, the bubble is so evident, right? Like you have this 1999 massive rise, and then there's a bit of a crack in late 99, but it comes back up in 2000. But by like middle of 2000, it's already on its way down. and it doesn't recover. By the end of 2000, Amazon stock is down 80%. And more importantly, the window is completely shut for any sort of financing for .com companies for 3, 4, 5 years. I mean, Google doesn't go public until 2004, which was the first major tech IPO after the .com crash. And so everything changed. Amazon needed to adapt the game again, time to survive. So in my mind, you look at the shareholder letters among some other things like interviews, and you realize that it's at this point that Amazon switches from this modality of get big fast into the modality of we need to get profitable, right? Like we need to have control over our own destiny. We've got massive runway. We were very smart in terms of building up our war chest, but now we need to go from this land rush mentality, and we're not going to invest in any more companies. We're not going to pursue things that are not immediately accretive to our customer base. We're going to cut costs as much as possible. We're not going to do anything that damages the customer experience or customer value that we're delivering. And we're going to get to profitability. And so, you look at some of their metrics, their operating loss by the end of 2000 is only 2% of sales, which compares to about 24, 25% in the previous years. So right there, you're already seeing in 2000 that they're battening down the hatches and cutting expenses pretty significantly. But then, by the end of 2001, they reached profitability for the first time, which had been sort of the thorn in the side. Everybody, most media outlets through the .com boom were very skeptical of Amazon because they weren't generating any profits. But of course, they were thinking with the wrong modality. Now, in this modality of there's no cash to be had, you have to finance yourself with your own cash flow. Amazon is doing the right thing, and they're achieving it. They achieved $35 million in profits in the fourth quarter of 2001. Amazon actually exits 2001, not just alive, but with almost every operating metric at the company in much better shape than it was, a year, 2 years, 3 years ago. Many of their .com contemporaries don't, right? And I think there is one paragraph in the shareholder letters that is really interesting to me as putting yourself inside the mind of Jeff Bezos as he was thinking about this. And he says, with a long enough financing runway, Pets.com and Living.com may have been able to acquire enough customers to achieve the needed scale. But when the capital markets closed the door on financing internet companies, these companies simply had no choice but to close their doors. And as painful as that was, the alternative, investing more of our own capital in these companies to keep them afloat, would have been an even bigger mistake. So this is Jeff saying, look, these were good bets, and if things had worked out, we would have looked like geniuses having bought these stakes at the time that we did. But it didn't. That's okay. It would be an even bigger mistake to double down and try to save them. Right now, it's inevitable they're going to go away, but we're going to be okay. And he's also, I think, building a lot of credibility and trust with his investor base by being this open and transparent with his thinking, which I think is pretty crucial because there's a lot of investors that hung on to Amazon for a long time and really were true believers. So I think maybe this is the right time to ask the question, why did they survive, right? I mean, in my mind, there was a few things. One, they were in a fantastic market that was massive. Jeff built the right DNA for the company, the right operating system. They focused on the right things, right? Things that don't change. And Jeff is famous for saying, when you're working in a market that's changing a lot, especially in technology, you should figure out what are the things in human nature that don't change. Like nobody's ever going to want higher prices, right? People want unlimited selection, fast shipping, great customer experience. Like those things are never going to change. They're never going to go away. And so they invest heavily in those. They were very bold and relentless in trying to get the scale first and fast. They were shrewd with their capital and resources. They built a war chest, and then they battened down the hatches and cut expenses to make sure that they would survive. And then underpinning all of this, I think you had a leadership team that was world-class at adapting, right? And building on top of a technology that was improving really fast every day. And so they had massive conviction because they're looking at the data every day, right? They're not fooling themselves or hoping for the best. They see the business works, even if the stock price tanks. So the question for them is basically just don't run out of cash, and this will work out just fine, right? And then somewhat counterintuitively, because they were the market leader in e-commerce, and because they were well capitalized by the time the crash comes around, the crash ends up killing a lot of competition, right? Because there's not going to be any more significant new entrants for another 3-5+ years. And there's a lot less capital for incumbents and probably a lot less conviction for incumbents like a Barnes & Noble to invest and grow online when the economy is in bad shape.
So I wrote down three things in addition to what you said that may have contributed to their success. One I'm kind of still forming, but the first one was, and I think we're seeing this as a theme across this time period. Focus on something simple in the beginning, and so they were focused on selling books on the internet for the first 3 years of their life and making customers super happy about buying books on the internet, and then they expanded. Right, 3 years. 3 years in this time frame is a million years, right? Like this. If you started in 95 and didn't, I mean, I'm sure there were all kinds of things they could have chased in that time period. And from what I can tell, they didn't chase those things. They focused. Second is we've talked a lot about capital raising. I mean, it's worth noting that we talked about an IPO. We talked about angels. We talked about an IPO. We talked about a term loan. We talked about a subordinated US bond, and we talked about a Euro bond and the convertible bond. And so I think another major lesson is you have to be connected to all these markets, right? If you want to succeed, you have to have your sort of tentacles in all the possible sources of capital, because capital moves. And so the ability to raise capital from wherever it is at the time, which could be retail, it could be Euro bonds, it could be Japanese bonds, like having the ability to. So that's like, that seems like that was probably Joy Covey's maybe thing. And then the third one is a little less formed, but like they were not immune to the mania, right? I think their biggest investment in a company was and the only one that was like really big was towards the end. And then when you look at 1999 is when their leased square footage like exploded. It went from like 500,000 to 5 million in 1999. And so like they weren't immune to the mania, but they participated in the mania in like a acceptable way, right? Like,
in a way that didn't doom them to die, right?
Yeah, like they leased some more square footage. These were mostly like pretty short-term leases, and they made some investments. They kind of like they sent the small boats, sort of in a sense, instead of the battleship. And I think maybe something like pre-planning for that, right? When things get crazy, there's that old saying, you got to be on the dance floor. Like you can't not be on the dance floor. But like how do we want to show up on the dance floor? What's the plan? Like what are the guardrails for when we're in the ninth year of the longest expansion ever, and the stock market's up 100%. Like
Right.
what are we going to not? And so that seemed like it may. I don't know how kind of well thought out that was on their side, but they played that pretty well.
Yeah. I mean, Jeff strikes me as a very thoughtful person, which I think is probably one of his superpowers, that he has pre-computed a lot of these things, and so he's sort of ready to go to navigate a lot of these situations. I think if we're going to summarize the lessons learned from this story of basically navigating hype, I think the title of this episode is going to be See the Wave, Ride the Crest, Survive the Crash. And I think that is the simple way to think about this mental model. I think you have to be in the right position, and you have to prepare yourself to see the next technology wave. And in this case, it meant somebody who is technical, who's in the right seat at the right time, surrounded by the right people, or at least by the right mentor, who can then allow you to build conviction around seeing the wave and being confident that it is in fact the wave, that you should jump and try to catch it. And then navigating the wave, you have to invest to compound, right? Like you have to build the core, you have to partner, you have to invest and be thoughtful about how you invest, like you said. And then you have to make sure that you build a war chest to give you the liquidity to survive the inevitable crash. And you have to make sure that you position your company as a leader with amazing customer loyalty and with a real business generating healthy operating metrics, so that when the crash inevitably comes and those financing windows close, you can survive through that recovery phase. And then you can capitalize on additional growth there. I think there is one excerpt that I want us to go out on here from that Increasing Returns article that, in my mind, perfectly summarizes the Amazon story and navigating this treacherous period, and not just navigating it, but being incredibly successful at doing so. And the excerpt is this: in the increasing returns world, every time the quest changes, the company needs to change. It needs to reinvent its purpose, its goals, its way of doing things. In short, it needs to adapt, and adaptation never stops. You can be smart, you can be cunning, you can position, you can observe, but when the games themselves are not even fully defined, you cannot optimize. What you can do is adapt. Adaptation, in the proactive sense, means watching for the next wave that is coming, figuring out what shape it will take, and positioning the company to take advantage of it. Adaptation is what drives increasing returns businesses, not optimization. So in my mind, Matt, if that doesn't summarize the spirit of Amazon and Jeff Bezos, I don't know what does.
That's great.
Should we leave it there?
Let's leave it there. Good
All
episode.
right, right on. Thank you, everybody. If you enjoyed this, best way to help us is to share this with anyone you think might like it and leave us a 5-star rating on Spotify or Apple Podcasts. And of course, to tune in next week for part 4, the final part of our .com series. See you guys.